Whatever you do, do not sell your silver right now. I know. You're looking at your screen, you're seeing red candles, the price just slid from $86 all the way down to $75, and every instinct in your body is screaming, "Get out." I get it. The forums are melting down. The trolls are out in full force, dancing on silver's grave. People who've never owned an ounce in their life are suddenly experts, telling you it's over. But I need you to hear me clearly. This is not a bear market signal. This is not the beginning of the end. What you're looking at right now is a gift. Because this drop to $75, it's not random. It's not chaos. It is the final piece of one of the most powerful structural reversal patterns in all of technical analysis, an inverse head and shoulders. And it is setting the stage for silver to make a run at new all-time highs. So before you panic, before you let fear make your decisions, sit down, take a breath, and let me walk you through exactly what's happening, why it's happening, and what you should actually be doing right now. Today is Thursday, February 12th, 2026. Silver is sitting right around $75 to $76 an ounce. And what's forming on the chart is something that should have every serious silver investor quietly excited, a textbook inverse head and shoulders pattern. Now, if you're not familiar with that term, don't worry. I'm going to break it down piece by piece. But here's the key idea you need to understand first. Real bull markets, the ones that actually last, the ones that make people generational wealth, they don't go straight up. They don't look like a rocket ship with nothing but green candles day after day. That's not how it works. Real bull markets are built on structure. They're built on higher lows. They're built on shakeouts that clear the weak hands so the strong hands can accumulate. And that is exactly what the algorithms and the market structure are creating right now. The pattern itself tells a story, and it's a story of seller exhaustion. Let me walk you through the anatomy of it, shoulder by shoulder, because once you see it, you can't unsee it. Let's start with the left shoulder. Back in late January, early February, silver came under heavy bear pressure. The price dropped down and tested the $74 support level. That was the first real test. The bears pushed hard. They threw everything they had at it, trying to break the market, and 74 held. Buyers showed up. The price bounced, but the bears weren't done. They were just getting started. That brings us to the head. And this is where it got truly ugly. This was the worst of it, the darkest chapter. The kind of price action that makes your stomach drop, that makes you question every decision you've ever made in this market. Price didn't just test 74 this time. It didn't even hesitate. It sliced through 74 like it wasn't even there, like that support level meant absolutely nothing. Silver went into free fall. It cratered all the way down to $64 in what can only be described as a vicious, violent, soul-crushing V-shaped bottom. If you were watching it happen in real time, you know exactly what I'm talking about. Every refresh of your screen, the number was lower. Every candle was red. The chat rooms were on fire, not with excitement, but with pure, raw fear. People were liquidating. People were crying. People were swearing they'd never touch silver again. And that move, that gut-wrenching plunge, did exactly what it was designed to do. It wasn't random. It wasn't some accident of the market. It was a deliberate surgical strike aimed at one thing and one thing only, clearing out the weak hands. It triggered stop losses across the board. Every carefully placed stop at 73, 72, 70, 68, all of them got hit like dominoes falling one after another. Traders who were overexposed, who were using too much leverage, too much margin, who had built their entire position on hope instead of planning, they got wiped out completely. Their accounts went to zero or close to it, and the people who set those stop losses thinking they were being smart, thinking they were managing risk, the market used their own risk management against them. It hunted those stops, ate them alive, and then reversed. That's the cruel genius of how these moves work. The pain wasn't a side effect. The pain was the point. The market needed to create maximum agony, maximum hopelessness, maximum I'm done with silver forever energy, because that's what capitulation looks like. That's what a bottom feels like. Not excitement, not hope, despair. It was brutal. There's no other word for it. And if you were holding through that, if you watched your portfolio bleed out and you didn't sell, I know how bad it felt. I know there were moments where your finger hovered over the sell button. I know there were nights you couldn't sleep, wondering if you'd made the biggest mistake of your life. I know because I've been there. Every long-term holder has been there. That's the price of admission in this market. You have to endure the moments that feel unsurvivable. But here's what happened next, and this is the part that changes everything. The price didn't stay at 64. It didn't keep falling. It didn't go to 50 or 40 or 0 like the panic sellers convinced themselves it would. Instead, the price rocketed back. And I don't mean it slowly crawled back over weeks and months. I mean it launched. It reclaimed $70 almost immediately, and then it didn't stop. It kept climbing, pushing higher, grinding through resistance, and it reclaimed $80. Think about the magnitude of that reversal, from 64 to 80. That's a $16 move to the upside, happening right after a crash that everyone said was the end of silver. The market was telling you something with that reversal. It was screaming it, actually. It was saying that $64 low, that was the capitulation. That was the absolute rock bottom. That was the moment of maximum fear, maximum pain, maximum surrender. And the market rejected it with violence. It rejected it with conviction. It said, no, we're not going there. We're not staying there. And it ripped back to the upside with a ferocity that left the bears stunned and the weak hands staring at their empty accounts, wishing they'd held on just a little longer. And now we arrive at today, the right shoulder. And I need you to understand something. This is the critical one. This is the moment in the pattern that separates the people who understand market structure from the people who just react to price. This is the pullback that tests whether the bulls have real resolve, real conviction, real backbone, or whether they're going to fold under pressure the same way they did during the head. Because the bears came back today. They showed up with everything they had. They slammed silver back down to $75, and they did it aggressively. It wasn't a gentle drift lower. It was a sharp, intentional move designed to create panic, designed to make you think, here we go again. It's another crash. It's going back to 64. But here's what they couldn't do. And this is absolutely crucial, so pay close attention. They couldn't get the price back to 64. They tried, they pushed, they threw everything at it, and they couldn't do it. They couldn't even get it back to 74, which was the left shoulder low. They couldn't even match the first sell-off, let alone the second one. Think about what that means. Really sit with that for a second. The left shoulder bottomed at 74. The head, the worst crash, the big scary one, bottomed at 64. And now the right shoulder, today's sell-off, is bottoming at 75. 75 is higher than 74. 75 is way higher than 64. That's a higher low. And in technical analysis, a higher low is not just a number on a chart. It is the single most important signal in this entire setup. It's the market's way of telling you, in plain language, that the bears are getting weaker, they're losing their grip, they're running out of ammunition. Each attack they mount is less effective than the last one. Each sell-off finds a floor that's higher than the previous floor. That means buyers, real buyers, committed buyers, are stepping in at progressively higher levels. They're not waiting for 64 anymore. They're not even waiting for 74. They're buying at 75 because they know what this pattern means. The floor is rising underneath this market, and a rising floor is not a sign of weakness. It is the hallmark, the signature, the fingerprint of a trend reversal in progress. So where does this go from here? Right now, $75 is acting as the right shoulder, and I want you to think of it in very specific terms. Think of it as a spring, a coiled spring that's being compressed tighter and tighter and tighter. Every failed bear attack compresses it further. Every higher low adds more tension. And springs don't stay compressed forever. They release. The trigger level, the neckline of this inverse head and shoulders pattern, sits up around $84 to $88. That's the line in the sand. That's the lid that's been keeping this spring compressed. And once silver breaks above that neckline with conviction, not a wick, not a brief touch, but a real sustained breakout, the pattern is complete and the measured move target kicks in. And here's how you calculate that target, because I want you to understand the math, not just take my word for it. You take the distance from the head to the neckline. The head was at $64. The neckline is around $84. That's a $20 distance from the lowest point of the pattern to the breakout level. Now, in classical technical analysis, you take that distance and you add it to the neckline breakout point. 84 plus 20 equals 104. Let me say that number again so it really sinks in. $104 per ounce of silver. That is what this pattern projects if it plays out. That is the measured move target. And measured move targets on inverse head and shoulders patterns have a remarkably strong track record of being hit. Not every time, nothing works every time, but often enough that this target deserves your full attention. Now, the entire thesis, everything I've just walked you through, hinges on one single level, $74. That number has to hold as the right shoulder bottom. It's the foundation of the entire structure. As long as silver stays above 74, the pattern is intact, the structure is alive and well, and the bullish case is firmly, confidently on the table. That makes this current zone around $75 a buy zone. And not just any buy zone, but one with tight, well-defined risk. And that's rare in this market. You know exactly where you're wrong. If price closes below 74, you're wrong and you can exit with a manageable loss. And you know exactly where the upside target is, $104. That's a risk to reward ratio that professional traders dream about. That's a clean trade. That's a clean setup. The kind of setup you look back on years later and say that was the one. But let's talk about risk, because I'm not here to sell you fairy tales, and I'm not here to pretend that the only possible outcome is up and to the right forever. What happens if 74 breaks? What if silver doesn't just dip below it, but actually closes below that level on a daily basis? Then the pattern fails. Simple as that. No excuses, no moving the goalposts, no, well, maybe it still works. It doesn't. The trapdoor opens, and you're likely looking at a retest of the $60 area, all the way back down to the head of the pattern. And I'm not going to sugarcoat it. That would be painful. Deeply painful for anyone holding. It would feel like the crash all over again. The forums would explode. The trolls would have a field day. The "I told you so" crowd would come out of the woodwork. But here's the thing, and I mean this with everything I've got. With every fiber of conviction I have, if silver drops to $60, that would be a generational buying opportunity. The kind of opportunity your grandchildren will ask you about. You bought silver at $60 during a global supply shortage? The fundamentals haven't changed. The supply shortage hasn't changed. The structural deficit, where industrial demand alone exceeds total mine supply, is still there. If anything, it's gotten worse since the last time we talked about it. Solar panels still need silver. Electronics still need silver. EVs still need silver. And the mines can't produce enough to meet that demand, let alone replenish the vaults. $60 silver in a supply-constrained market is the kind of opportunity that comes along once in a decade, maybe once in a lifetime. If that happens, I'm not running for the exits. I'm not panicking. I'm doing the opposite. I'm selling other assets and converting them into physical metal. That's how strongly I feel about the underlying fundamentals here. That's how deep my conviction runs. Now, I know a lot of you are asking a fair question, and it's one I get all the time, so let's address it head on. If there's truly a shortage, if the fundamentals are this strong, if demand is outstripping supply by this much, then why does silver keep getting slammed back to 75? How does this keep happening? How is the price going down in a market where there isn't enough supply? It doesn't make sense on the surface, and you're right to question it. The answer lies in something I call the China Seesaw mechanism, and it is one of the most important dynamics in the global silver market that almost nobody talks about. Mainstream analysts don't mention it. The financial media ignores it. But once you understand it, suddenly these price slams stop looking like evidence against the bull case and start looking like the desperate last gasps of a system that's running out of options. Here's how it works. In China, there are essentially two silver markets operating side by side. You've got the official Shanghai Gold Exchange, the SGE, where silver trades with VAT, value-added tax, baked into the price. That's the institutional, regulated, above-board market. Big refiners, big industrial buyers, banks, that's where they transact. And then you've got an unofficial market, a shadow market, essentially. This is where scrap silver trades tax-exempt. And by scrap, I mean anything and everything. Small recyclers collecting silver from old electronics, mom-and-pop jewelry shops melting down unsold inventory, individuals bringing in family heirlooms, broken silverware, old coins, even pieces of silver extracted from circuit boards and industrial waste. Anyone dealing in this scrap can sell it without paying VAT, as long as they stay under roughly 14,000 RMB per month in transactions. That's the key threshold. And what happens between these two markets is a seesaw effect. When the official SGE supply starts drying up, when the registered vaults get thin, when deliverable silver becomes scarce, when rationing kicks in because there simply isn't enough metal to go around, it creates a vacuum, a supply vacuum. And nature abhors a vacuum, and so does a market. That vacuum gets filled by a flood of scrap from the unofficial side. All these small recyclers and individuals see the high prices, see the opportunity, and start pouring their silver into the system. And because they don't have the VAT burden, they can undercut the official SGE prices. They're selling cheaper silver, and that wave of scrap supply hitting the market pushes prices down. That's the slam. That's what you're seeing when silver drops from 86 to 75 despite every fundamental indicator screaming shortage. But here's the critical part. The part most people miss. The part that makes this entire mechanism ultimately self-defeating for the bears. Scrap is finite. Let me say that again because it's the key to everything. Scrap is finite. Every old necklace that gets melted down is gone forever. Every piece of heirloom silver that grandma kept in the cabinet for 40 years, once it gets recycled, it doesn't regenerate. Every circuit board that gets stripped for its silver content. That silver was put there during manufacturing, and once it's extracted, there's no more to take. This is seed corn being eaten. The system is consuming its own reserves, its own buffer, its own emergency stockpile to keep prices suppressed in the short term, and every ounce of scrap that enters the market is one less ounce that will ever be available again. The fact that the market is relying this heavily on scrap to fill the supply gap is not a sign of abundance. It's a sign that the vaults are empty and the system is cannibalizing itself. That scrap seesaw is a pressure valve, and pressure valves only work until the pressure becomes too great, and we are getting very, very close to that point. Let me shift gears for a moment and talk about something happening on the US retail side that I think is incredibly significant, and it flew completely under the radar for most people. APMEX, one of the biggest, most well-known precious metals dealers in the entire country, had recently implemented order minimums during the peak of the retail mania. Think about what that means. Demand was so overwhelming, so intense, that one of the largest dealers in America had to tell customers, "You can't buy unless you spend at least this much." They physically couldn't handle the volume of small orders flooding in. That's how crazy the retail frenzy had gotten. Well, those minimums have now been removed. And most people, the casual observers, the surface level thinkers with Taramawarim, would look at that and say, "See, demand is falling. Nobody wants silver anymore. The fad is over." But that is exactly the wrong interpretation. What it actually signals is that the tourists are gone. The hype chasers, the people who were buying silver because they saw a viral video, the folks who panic bought at the top because their cousin's roommate told them silver was going to $1,000, they've moved on to the next shiny thing. They've left the building. And what's left behind is something far more valuable than a frenzied crowd. It's a clean market, a quiet market. A market where the smart money, the whales, the serious long-term accumulators can buy in size, real size, without driving prices up prematurely, without creating the kind of frenzy and volatility that makes it impossible to build a meaningful position. The silence is bullish, and I know that sounds counterintuitive. How can silence be bullish? How can a lack of interest be a good sign? Because when nobody's talking about silver, when the forums are dead quiet, when the retail crowd has completely lost interest and moved on, that's when the big money moves in. That's when institutional accumulation happens, slowly and patiently, without fanfare, without headlines, without anyone noticing. Every single major move in precious metals in history, every single one, has been preceded by a period of silence and disinterest. The calm before the storm. And this, right now, is that period. And while we're on the topic of contrasts, let me touch on something that I think provides a really useful frame of reference for why the silver community's approach is fundamentally more sound than what we're seeing elsewhere. I'm talking about the crypto world, and specifically the Michael Saylor school of thought. Now look, I'm not here to bash anyone's investment choices. People are free to put their money wherever they believe in. But I think there's an important philosophical difference worth pointing out because it speaks directly to how we think about risk, resilience, and long-term survival in volatile markets. In the crypto space right now, there's a prevailing narrative that says there's essentially no downside. The messaging is relentless. Leverage up, buy more, number go up forever. Don't worry about risk because risk doesn't apply to us. Hubris is at all-time highs. The confidence is absolute, unshakable, and completely untethered from any acknowledgement that things could go wrong. And that kind of thinking, that kind of delusion, because let's call it what it is, it creates fragility, enormous, catastrophic fragility. It creates a system where every participant is positioned for one outcome and one outcome only, up. And when reality doesn't cooperate, and eventually reality always has its say, the crash is devastating, not because the asset is bad necessarily, but because nobody prepared for it. Nobody had a plan for down, nobody hedged, nobody held back reserves. Everyone was all in, leveraged to the teeth, utterly convinced that the rules of gravity had been permanently suspended. Silver is the opposite, and I say this with genuine pride. The silver community talks about risk openly and honestly. We prepare for a drop to $60. We discuss what happens if the pattern fails. We game out the worst case scenarios, not because we're pessimists, but because we're realists. We hold physical metal, actual tangible silver that you can hold in your hand, that has no counterparty risk, no leverage attached to it, no exchange that can freeze your account, no protocol that can be hacked. That humility, that willingness to say, I could be wrong, and here's exactly what I'll do if I am. That is what builds resilience. That is what allows you to survive the drawdowns, to weather the storms, to still be standing and solvent when the real move finally happens. The crypto approach of pretending downside doesn't exist is a recipe for being completely wiped out when the music stops. The silver approach of respecting risk and preparing for it, that's how you build lasting, durable, generational wealth. All right, let's bring this all together with the key price levels you need to have burned into your brain. Think of this as your war room map, the 3 numbers that define everything about where silver is and where it's going. $74, this is the critical support line. It's also a key Fibonacci level, which means it's not just a round number on a chart. It's a level where mathematical market structure converges with real buying interest. As long as silver holds above 74, the bull case is alive. The inverse head and shoulders pattern is intact, and the path to higher prices remains wide open. If 74 breaks, if we get a convincing close below it, then the flush to $60 is on the table. And if that happens, you don't panic, you buy hard. $88, this is the neckline. This is the breakout trigger. Everything we've talked about today, the pattern, the structure, the measured move, it all activates when silver breaks above 88 with conviction. A clean, decisive move above that level confirms the inverse head and shoulders, completes the pattern, and opens the door to a run at all-time highs. When silver breaks 88, that's when things get very real, very fast. $60, this is the hard floor. It's right around the all-in cost of production for many silver miners, which means at that price, mines start shutting down, supply contracts even further, and the shortage accelerates. It's the ultimate buy zone. If silver ever touches 60 again in this environment, with these fundamentals, with this supply deficit, with industrial demand where it is, you back up the truck. That's a gift from the market gods, and you don't waste it. So here's the final verdict. What happened today, this slam down to $75, it was a bear trap, plain and simple. It was engineered, it was intentional, and it was designed to do one thing: shake out weak hands, trigger panic, and get you to sell your silver right before the right shoulder of this inverse head and shoulders pattern sets up the breakout of a lifetime. The market has been sanitized. The tourists have packed up and gone home. The whales are accumulating quietly in the background, while everyone else is distracted by red candles and fear. The scrap supply that China has been using as a pressure valve is finite and diminishing, with every ounce that gets melted down. The shortage isn't getting better, it's getting worse by the day. Your job right now is straightforward. Hold the $74 line in your mind as your line in the sand. Stay positioned, stay focused. Don't let the red candles, the noise, the trolls, the panic posts, or the silver is dead headlines shake you out of what could be the most significant move in silver's history. Prepare yourself mentally and financially for the $88 neckline breakout, because when it comes, and the structure says it's coming, the measured target is over $100. Stack now, hold strong. And when the rest of the world finally figures out what's happening, when silver is on the front page of every financial website, when the tourists come rushing back in desperate to buy, you'll already be there. You'll already own it. And you'll know that the price you paid was the price of patience, conviction, and the courage to hold when everyone else was running for the exits.